Hi, I'm Chris Clayton, Managing Director here at CBW Financial Planning. So, as we approach the end of 2023, it's been another year of volatility in investment markets. Given how the last 3 years have looked, with short-term interest rates rising, a common question we get asked is, why bother when I can get reasonable returns in cash? To be fair, I think this is a reasonable question and understandable, but there are a number of basic fundamentals as to why jumping into cash may not be a sensible move. I've been in the industry for about 30 years and have seen this proven time and time again, but there's still times when I have to remind myself to stay disciplined. Given this, we asked Ben Kumar at Seven Investment Management to explain the science and rationale behind staying invested in difficult markets and the rewards that this can bring.
As Chris said, it's a really common question, and I completely understand why. For the first time in more than a decade, cash looks like something that is getting people interested. And so, when they look at 5% on their bank account, they're saying, what's the point in investing? Well, there's a few things to remember. The first is that the laws of capitalism aren't broken. What do I mean by that? Well, cash sets the hurdle. If the cash account is 5%, everything else, every other investment you can possibly make, needs to do better than that to tempt you out of the cash account. So, government bonds have to offer a little bit more than cash, otherwise you aren't investing with the government. Corporate bonds have to offer a little bit more than the government's, otherwise you'll just stay there. And for equity investors, there needs to be at least the promise of more than 5%, otherwise no company will have any shareholders left. That's the first thing to remember. The second thing, and Chris alluded to it, is that we've been here before. You know, if you go back to the mid-1990s, the average cash rate was 5.3%, roughly where we are now. And during that time, equities, look at the FTSE 100 for example, delivered more than that, 8.1% a year. Cash set the bar, and the equity market jumped over it. So although the first stage of a rate rise can feel a little bit uncomfortable, it can feel like investing doesn't mean anything anymore, the fact that cash rates have risen actually means that returns for all other asset classes over the long term, which is what we invest for, should be going up as well. And look, when you start looking at the data, when you look at the history, if you put cash up against almost any other kind of investment, a multi-asset portfolio, in the long run, cash isn't the winner. If it's a two-horse race, I know what I'm backing.